one? Okay. And the count starts.
Hi, everyone. Welcome. We'll get started in a few minutes. We're just letting a few more people join. We have a lot to cover. Bill is ready to go, so I'll get started. Hello and welcome to Pitch Prep 101. I'm Julie Cranston, Director of the SBDC at UCI Beal Applied Innovation, and I'd like to thank you so much for joining us today. Today's webinar is brought to you by the SBDC at UCI Beal Applied Innovation. The SBDC is funded in part by the U.S. Small Business Administration and the state of California. The SBDC is here to help you start, grow, and succeed in your business by providing expert consulting and training such as this webinar. In addition to our regular consulting on business development and funding, we also have been helping our small business clients deal with business challenges related to COVID. We have a hotline set up and additional resources available. So if you need assistance, please get in touch with us to see how we might be able to help. Our hotline number is 1-800-616-7232, and we'll put this number in the chat feature. A little housekeeping before we begin. Everyone is muted during the webinar. Tomorrow, the recorded webinar and a PDF copy of the slides will be sent to all participants. There will be Q&A at the end of the presentation, but please feel free to ask questions during the webinar by clicking on the Q&A box at the bottom of your screen. Our program today will be presented by SBDC at UCI Senior Business Consultant, Bill Waldo. Bill was the founder and CEO of his own food service sales and marketing company for 25 years, handling food service sales and marketing functions for some of the nation's largest food manufacturers, such as Nestle, Sara Lee, and H.J. Heinz. His team grew to over 75 people, including 4 executive chefs in multiple locations. He's served on several national advisory boards and was president of Market Tech, a national industry collaboration group. In 2006, after the sale of his company, Bill joined Tech Coast Angels, becoming an investor, membership chairman, and board member. He's been an SBDC consultant for 13 lucky years. Bill, thank you so much for being here today. I will now turn the program over to you.
Well, thank you, Julie. That was a great introduction. I appreciate that. You covered an awful lot of detail in a very short period of time. So thank you again. So welcome, everyone. We've got a pretty good sized crowd today, so I think I need to stay on top of my game and make it worth every minute that you're going to spend with me. It also looks like there's a few people out there that would like to raise some capital, probably in the very near future. So let me begin by explaining to you the key areas that I want to cover today. You know, it's the pitch deck is always important. It's a critical part of the presentation, but it's becoming prepared. And that's what I want to cover today as well, is getting the proper traction where you really need to be before you even spend a minute putting together the pitch presentation. I get a lot of requests to help with pitch decks, but what's really important, and I'm going to cover that today, is the preparation, you know, the momentum, the traction necessary to really improve your chances of getting investor interest, and that's what I want to do. Obviously, as Julie alluded to, I've got a lot of passion for this. With my time with Tech Coast Angels, with my now in my 14th year with the Small Business Development Center, my goal is to help clients, you know, get to that next level, help them become prepared for what I call the audition. Okay, it's the pitch presentation, but it's the audition. It's, you know, everybody wants to audition. They want to be able to get picked, and you know, a typical investor today, they're going to probably do 2 deals a year. And the goal for me and for yourselves is we want to be prepared and have the right presentation to where you're one of the ones that's picked by the investors. So, excuse me, with all that said, and I believe Julie also said, if you have questions with quick answers, I'll attempt to answer them as we go through it from the chat box. And if not, I'll do my best to answer your questions at the end of the presentation. Okay? So let's move on. So let's, I guess we got this first slide right here. Now we'll go. Let's talk about one of my favorite topics. Most of you have heard this before. It's the famous elevator pitch, okay, or fast pitch. I'm sure you've heard of many contests that are out there about the fast pitch, the elevator pitch. It's absolutely critical that you master this as soon as possible, not just for investors, but also for your customers. You have about a minute, and this is known for a fact throughout various investor groups and different presentations that I've been through. You got about a minute of attention when you're doing your initial presentation. Otherwise, it goes into what I call cognitive drifting, where they just start kind of going off the different direction. So the goal is to articulate in that very first minute exactly what do you do, why do you do it, what are your key differentiators, how you do it, and who is your customer. Now on this slide here, I said 30 seconds, but if you can do it in 30, that's great. But you should be able to probably take about 45 seconds. Bottom line here is they have to have that aha moment in that first minute or you lose them typically. Or they got part of it, but they put the other part, they put you in the wrong box and you lost them anyway. I also encourage you to present this to any friends, family that will listen to you. Ask them to humor you for a minute. Give them your pitch. Then have them repeat it back to you. And if they've got it, beautiful. You're spot on and you got the elevator pitch mastered. So this is one of the areas of mistakes that a lot of entrepreneurs make is they're not articulating clearly exactly who it is, who they are, what's unique and different about them, and who their customer is right out the gate. So it's these first three slides that really set the stage for this story that I'm going to share with you that we're developing here. Okay, so once we've articulated the elevator pitch, we get into the problem. You know, every entrepreneur has identified a problem or a pain in the marketplace, okay? And they want to come up with a solution for that. So identify and I'm a big fan of bullet points, okay? Maybe it's 3 or 4 bullet points, but you want to identify what is the problem in the marketplace that you see, and you know, we want to be able to articulate how big is the problem, so that investors understand clearly what the problem is you're trying to solve. And if you use bullet points versus a lot of content, you'll keep their attention much better. Again, for cosmetic sake, less is best in an investor presentation because you don't want them reading your slide, you want them listening to you, okay? So following the problem, okay, is the solution slide. How does your product solve the stated problem? So if you had, let's say you had 4 bullet points stating the real problem you saw in the market that has to be solved. This should follow that bullet by bullet on how ABC company is going to solve that problem or come up with a remedy for that particular pain point. So this now sets the stage, okay? So the first 3 slides, got the elevator pitch, I understand the space you're in, I know what's unique and different about you. Now I'm able to understand the problem that you're working on, and now you're going to share with me how you're going to solve that problem. And that's now the stage has been set. And I'm now really paying attention as an investor because you now have my attention. That is so critical to kind of line it up that way. Next, we get into the, excuse me, the market size. Okay. Most of you have heard about the famous TAM, the SAM, and the SOM. And its bottom line is it's spelled out here. We as investors, we want to know how big is the market you're trying to address. You know, is it a significant market? Is it huge? Okay, what does huge mean, right? Are we going to talk about a global market, or are we going to talk about domestic, or are we going to talk about both? So market size, TAM is the whole world. I mean, that's everything. If you had let's say you're selling light bulbs. If you had every fixture in the world, that would be your total addressable market. But if you are selling just fluorescent tubes, okay, so now you're narrowing it down to the serviceable or the available market. And then you get to the SOM, which is that's really the most important part of this. That's the part of of the TAM that you feel like you're going to address. I call it the entry level. This is the piece of the market that you feel is the most obtainable right out the gate. So you've got three different sizes. You know, it can be a 5 billion TAM, it can be a 3 billion SAM, but it's a 500 million SOM. And that's kind of laying it out the best way I can share with you. But it's important to be as realistic as you can with this and be able to identify it or quantify it by dollars or by numbers or people, but you want to have a basis to build this on. Excuse me. So this one, it's an ugly slide. I complain about it every time I show it, and I haven't fixed it, and I need to do that. But it's also my favorite slide when I'm working with clients because it does several things. It provides an excellent visual to the investors as to what's unique and different about you. If they didn't quite get it at the beginning, this is going to help them because you're going to take a piece of paper, okay, or a slide. That very first column is going to be all the benefits that your company offers. Maybe you list 8 benefits, okay? Next column over is your company's name. And guess what? You get a check mark all the way down because you have all of those benefits. The next column over is going to be your nearest competitor or anyone that's really in your space that is competition. They may only get 2 or 3 check marks because they only have 2 or 3 benefits that you're offering, okay? Same thing with the next 2 or 3 over. You'd like to ideally have 4 companies up there that you consider to be, excuse me, competitors in your space. Now, and if they don't have it, leave it blank. And when you create this document, you'll look at this and you'll be able to clearly explain to a potential customer. You know, this could be a great marketing tool. People always want to know why you, why now? Okay, well, this is a good visual to offer them. Why you, why now? Because you're going to be able to show, excuse me, all the key differentiators that causes them to not want to go another minute without going with you because it's very clear what you offer versus everybody else. It answers that why you question that comes up all the time. So this is a critical slide, and again, one that I would always recommend that you use because it's extremely beneficial, okay? For some reason, I'm not, okay, I'll just have to move it myself. Okay, next one is, this is another favorite slide. It's the team. We use the saying all the time about investors, how they have to love the horse, okay? I mean, they got to be madly in love with the horse. But guess what? They have to be absolutely overwhelmed with the jockeys. Because at the end of the day, it's the team or the jockeys that they're going to write a check to. So we want this slide to really jump out and really send a message that clarifies each individual team member is uniquely qualified to grow this business to whatever level we're going to project as we go forward on this presentation. Okay. I recommend on the team slide that you share, maybe it's a paragraph of your accomplishments. Okay. I'm happy if you're a PhD or if you have an MDA or if you're an engineer, that's all great. But what I want to see as an investor is what have you accomplished in your past? If you had a startup, great. If you had a failure, okay. But either one or both tells me you've got the experience as a startup. If you had a failure, okay, you've had a great experience there and you've recovered from that. So you've learned both sides. Or let's say you work for, let's say GE, and you took over a division there that was at 5 million. When you left, it was 75 million in sales. Those types of accomplishments are very important to point out as you do the management team. So current strengths, education, overall experience. Those are the key things you want to bring out. You usually a paragraph, you can do it. And you can also just add a little bit and walk into a little bit further. But you want to make sure you've got the team out there and you really want them to jump out and you want to brag about it. And if you're the CEO, which you would be if you're doing the presentation, this is not a time to be shy. Just let them know with all the passion you have of all the reasons why you feel like you are uniquely qualified to do the to grow the business. Okay. Now, next slide would be the advisory board. So the advisory board is equally important if you're listing members that have a bio themselves or a paragraph, as I said earlier, that shows they've got some gray hair, okay, but they also have a network in your space. So by reading their bio or their paragraph of accomplishments, it's pretty clear to me as an investor that a phone call from you to them could open up many doors and help you grow your business. So if that advisory board person has listed, background in various areas and obviously has a clear network that can open up doors for you. So now for me as an investor, I'm impressed. That really adds value to the whole value here and also enhances the management team because you've got a highly experienced, highly seasoned advisory board with some very good contacts. And that's really what's important with that. I tell clients putting your attorney on there or putting your CPA on there, it's not necessary. They're not going to help you grow your business. They're going to probably help you stay in business. But what I'm looking for as an investor or what investors are looking for are advisory board members with that experience. Okay. Okay, for some reason, this does not want to advance. Right, there we go. Hold on here. Got it. Okay, so next one is, excuse me, the go-to-market strategy. I've got questions up here, but they're not popping up. Not sure why. Anyway, go-to-market strategy is one of the questions I ask pretty much in every presentation. If I'm going to give you $1 million, I need to know what kind of plans do you have to reach out to the masses right away? I need to know there's a good sales plan in place. Now I call it sales and it's really a sales channel strategy. And then there's also a marketing channel strategy, okay? Both are critical, but they are uniquely different. And anybody in sales or anybody in marketing will not probably argue that. So the go-to-market strategies, who are your customers, for starters, okay? We need to identify that. Along with that, we need to identify, are we a B2B, or in other words, a business-to-business model, or are we a business-to-customer model? Both work, both are uniquely different, and you want to make sure you've identified that so that the investors understand you're either a B2B or you're a B2C. A B2C would be like an e-commerce platform, okay? So on the channel strategy, I need to know, how are you going to push it out there? Ideally, I'm looking for an efficient and effective sales vehicle. So brokers, for example, if you're in the retail side of it, let's say you've got a food product, you hire an independent sales agency, as they were called, brokers, which is what I did in my company. Now you've got an efficient agency that has access to your target customers. They provide you with access. They open up the doors for you. You pay them for performance. Unlike your own direct sales force, where you're paying big salaries, whether they perform or not, with these brokers or independent reps, you're paying them for performance, which is probably the most efficient and effective way to grow a business quickly. And one investors like, because they understand that you're frugal, you're smart, you're going to grow fast because you've got other sales mechanisms out there that's going to help you build the business rapidly. VARs are value-added resellers. Depending on which type of business you're in, sometimes the value-added resellers, again, they open up doors and they help you move product. They provide access to the customer because they already have the relationship. Independent reps, I have many clients that have gone out and found independent reps. Let's say it's going into the medical world or into hospitals. Now they've got other products that they sell as an independent rep to the same target customers you're going after, and they add your product to their bag, and now they open up doors and they're able to open up and talk about your product. The customer trusts them because they're already buying from them, and it enhances your ability to be more effective and again open up doors and have another pay for performance sales channel, which is ideal. Direct sales, many times that's absolutely necessary. It depends on the company, on the type of business model that you are or you have, but direct sales is it's usually required. Less is best. And in some cases, if it has to be direct sales, then it is. Oftentimes you'll have a direct, like a business development manager, that's your team player that is responsible for managing and growing the broker network of the value-added resellers or the independent reps. So that just is just to give you an example of some of the different sales channels that are important that you want to consider. Okay. Marketing channel strategy, it goes the same way. We want to talk about, everybody has the ability or talks about social media marketing. Well, that's all great as long as you have someone that clearly understands how to utilize that platform, how to reach out to it, and how to make it a sales tool. Okay. Maybe it's a blogging component. There's multiple areas where the pros that really understand social media marketing know how to use that to the max and can really reach out. Oftentimes they'll get key influencers. I have a lot of clients today that are marketing using key influencers, and it's becoming extremely popular and many times very effective. And again, that's based on performance. So you've got direct marketing. You can do the emails, you can do all the different things direct, you can use the social media platforms. And the other one that I really like and encourage are alliance partners. Now, these can be people that have other products, but they're going after the same customer you are. And by you partnering with them, you're helping them out because they can open up a door for you and you can open up a door for them. You have to give some thought to that, and each case is a little bit different, but there are multiple opportunities out there for what we call alliance partners. So you want to consider that. So these are just some of the suggestions that I have for you today that will help you think through your sales, distribution, channel strategy, and your marketing channel strategy as well. Both are very important. Try and move here to the next one. So again, this is fun. I'm going to get there. I apologize for this. Okay, business model. Okay, the key part of the business model is it answers a very simple question. Investors want to know, how do you make money? Okay, not a bad question. And you want to communicate that in the best possible fashion. I mean, ideally, what we're looking for is recurring revenue. Any business model that has a recurring revenue process is the attraction for most investors. Excuse me. So you want to show the revenue streams. It could be a subscription model, which is a very popular one, but that's a recurring model that I talked about. A SaaS platform, software as a service. Again, that's a recurring typical model that's very popular. Another revenue stream could be advertising. A lot of people will talk about digital advertising or other types of advertising. That's a longer one. It's a difficult one to get because you really have to be of significant size before you're attractive to advertisers. But whatever those streams are, you want to think them through. I've got some clients that added data analytics. That was one of the components. And it turns out that wound up being one of their more profitable revenue streams. So take a look at how you're planning on making money and be able to list it, excuse me, on the slide that identifies that we have 3 revenue streams. We're gonna depend on subscription, we're gonna depend on advertising, and we're gonna be able to take the data analytics and we're gonna be able to draw revenue off of that as well. So those are the things you wanna be able to bring out. Ideally, having 2 or 3 is better than just 1, but if it's 1, it is. Bring them out so that people have a chance to appreciate it. Wow, almost did it. You would think this would be simple by just pushing a button, but it doesn't want to go. Ah, there we go. So intellectual property, question that comes up all the time and when you're doing a presentation is barriers to entry. Okay, so how difficult is it going to be for somebody else to copy what you're doing and take off? Even if you have a patent pending, all they have to do is have a slight iteration and they're not really violating your patent. So barriers to entry is something you want to give some serious thought to protect yourself. You know, are there any proprietary assets? If you do have intellectual property, beautiful. This is a good time to broadcast it and tell people about it. It's a very important part of the presentation, is identifying barriers to entry, how you're going to protect yourself and make it more difficult for somebody else to get into your space. Financials. This one is probably one of the, again, a very important slide to have. And I've got suggestions for you to show you that will make it easier, but it doesn't need to be 3 or 4 pages of a lot of detail. That can be an appendix for the future when you get into due diligence. You can have all that detail, okay? But for an investor pitch, where you typically have about 12 minutes, if you're in front of an investor group, you normally are timed, for example, at Techos Angels, they have 12 minutes to pitch. Then they get 12 minutes of Q&A. So you want to have yourself set up to where you can pitch this in 12 minutes. That means your financial slide should be clear, concise, and current. It needs to be realistic, but it also should show significant scalability. And when I say avoid hockey sticks, I'll give you some examples of what you don't want to do. Is put out a 5-year projection, and you're stating that you're going to start off in year 1, you're going to hit let's say $4 million. In year 2, you're going to hit 25 million. Year 3, 45 million. Year 4, 50, and year 5, 150 million. Those are hockey sticks that are not realistic. You want to avoid that. You want to show a good, realistic growth pattern, just a nice, solid growth pattern, and avoid the big jumps because they just create credibility issues. And a lot of this 5-year financial projection, it's about credibility. I can be honest with you, investors don't believe these slides. They don't. But they also know that they're projections. That's exactly what they're called. So the goal here is to share with them your thoughts, your formulas, and your vision on how you see your company growing over the next 5 years. So if you took off on a nice path like this, and let's say you're projecting $35 million in sales in 5 years, that would be credible, depending on what type of business that you're in. But it's when you get up to showing that you're going to do $1 billion in 5 years, when in reality, 95% of all companies struggle to ever get to $10 million. So you want to keep your credibility intact. You want to show that it's a well thought through 5-year projection. I recommend using a P&L type format. It's easy to read. You start off with your first line as gross revenue. First year, X amount of millions. Second year, third, fourth, and fifth. Right below that, you can show COGS, for example. Everything is deducted from the top line, of course. Underneath that, you put your G&A, your general and administration, or SG&A, where you put in your sales and marketing costs. I recommend on a 5-year financial, because sales are so important to investors. Do a line and take the sales and marketing and add that as a separate line item out of your G&A, so that it shows the investors how much money you've allocated for sales and marketing out of your budget. That is a critical piece that they want to see. It's always helpful and a little bit more compelling to bring that up. Okay. Then you get into your gross profits, and then you get into your margins, and you can do EBITDA, which is preferred. That's earnings before interest, taxes, and depreciation. But bottom line is, you've got a simple 1-page, probably 7 lines or 7 rows of information that gives them a pretty clear snapshot of what you're projecting as your 5-year performance. And that's really important to lay it out that way. And I think you'll find it to be very effective. I have examples if anybody has questions on that, I can share that with you. Wow, actually made it this time. So next slide. This is another slide that's a popular one, the deal. You can title it as such, or you call it the offer, okay? Whatever you want to call it, but this is where you're now about to share with the investors how much money you're looking for, okay? So what I recommend is on that slide, if you have put in $100,000 of your money, and let's say, for example, you raise another $200,000 from family and friends, list that on there and open up with that. It's very important to show skin in the game for the entrepreneur, okay? But then it's also important to show that you have early adopters. Others decided to jump in already. So you're not looking at me as the investors, the first one. You already have early adopters already on board. So let's say you've already raised $300,000. I recommend you put that out there right away and state that and where it came from, okay? That's an impressive number, okay? Next, you're going to put down, okay, how much money do you want to raise? Okay, let's say you're trying to raise $1 million. Okay, then underneath that, and keep it that simple, it's just, right straight down. Underneath that, what are you offering for that $1 million? Okay, so how much money have you raised so far? How much money are you seeking? Okay, and then we get to the offer. So it's the instrument I'm talking about. Typically, it's one of two. It's going to be equity, or what they call a priced round, or it's going to be a convertible note. Convertible notes are very popular. Last year, we at TCA did, I think it was 60% of our deals were convertible notes. And it's your call. When you're going after a Series A round, a convertible note can be an effective tool. And they are popular. There's also a safe note, but I can tell you, if you're thinking about that, keep in mind that traditionally investors do not like and will not accept safe notes because there's nothing in it for them. So a typical convertible note is going to have an interest attached to it because it is a promissory note. Okay, it's going to have a discount added to it because they're offering the early adopters or the early investors. It's typically a 20% discount when it converts to stock. So let's say 2 years from now, the stock is at $5. It's gone to stock. They get a 20% discount, so they're going to get it for $4, for example. So that's what the convertible note is all about. So that is the deal slide. Next slide is going to be use of funds. This is where you want to lay out and spell it out. If you're raising $1 million, show me, not with percentages, but dollar value. Show me maybe 3 or 4 buckets, okay? One of the buckets is going to be sales and marketing. Another one can be R&D. Another one can be G&A, your payroll costs, your leases, legal fees, etc. But just kind of lay out 3 or 4 buckets of how you're going to spend that $1 million. Now, Again, as an investor, I have a pretty good idea how well you've thought this through. And that's what's important. Just make sure a good number for sales and marketing has been allocated. That is a very important one for you guys to have on that. And then you're going to get the question, okay, so if I give you $1 million, how far is that going to take you? Okay, is it going to take you to revenue? Is it going to take you to cash flow positive? Is it going to take you to profitability? Or is it going to take you to a liquidity event? So we, as investors, would like to know how far your plans are. There's not necessarily a right answer. It's just share with us that you thought this through, and the $1 million is going to take me to cash flow positive. And we want to have a clear view of your future capital requirements. How long will the investment last? And timing for incremental capital is what I'm trying to say here. So again, if it's $1 million and it's going to take you to, let's say, cash flow positive, wonderful. You could also state then that we plan on coming back for a more serious and a more aggressive round after year one, and that's fine. But we want to be able to understand what your thought processes are there, so that we know that you're properly capitalized and that your thinking is on course with the growth of the company. What we don't want to see is somebody raising, say, let's say $500,000, and it gives them a runway of 6 months. That's a mistake, and I'm trying to encourage not to make that mistake, because that means you're going to be back raising capital, which is a pain in the foot. Everybody knows that. Very time consuming and a huge distraction. So raise enough money to give yourself at least a 10-month runway. And if it does take you to cash flow positive, or it takes you to profitability, all those are wonderful, but give yourself a breathing space of about 10 months with that first round, so you're not right back at it again trying to raise money. Okay. Boy, almost have this mastered. Next slide. Very, very important slide is your exit strategy. Okay. So it doesn't have to be complicated. All you want to state is that, number one, you have one, because if you don't, you won't be investable. Investors don't invest in lifestyle companies. Nothing wrong with a lifestyle company. That's what I had. But if you're building a company and you're scaling it and you're building it to eventually be acquired, then you're investable, because what investors are looking at is that it's the exit is going to be the only time an investor is going to make any money. If he's going to make money, it's going to be when you sell the company. So they're looking at about a 5, maybe a 7-year timeline before the company is acquired. So what we're looking for here is a very simple exit strategy. So what is it? Acquisition? I would suggest that, because 90% of the time, that's exactly what happens. A company is acquired. Okay. IPOs, I put that on there because some people want to do that. They're typically not realistic. IPOs are very expensive, and it's usually not the best way out. But if you got the type of company that can handle that, wonderful. That can be one of your exit strategies. Merger, similar to an acquisition, depending on what the terms are. But then I also recommend, now that you've listed your exit strategy, okay, it doesn't need to be any more complicated than that. You have a strategy, and you're sharing that with us. List who would be maybe 3 or 4 of the likely suitors. It doesn't mean they're going to be the ones that buy the company, but just show, as I did here. Obviously, I'm giving you an exaggerated example because, you know, everybody wants to show Disney or Mercedes would be an acquirer, but pick 3 or 4 companies in your space that you feel are likely suitors or acquirers in the next 5 years, and just put their logos on there. That's it. That's all you need to do. Doesn't need to be any more complicated than that. But you've told me and you've shared with me that you've got an exit strategy, and here's some of the likely suitors. By the way, I'm trying to also share with you what I consider to be a good sequence of slides too. The sequence is important because you're telling a story, And you want to keep it exciting. You want to keep everybody's attention as you go through it. This is now we're at the end here. So I have a firm belief in what I call a free real estate slide, okay? I call it free real estate because if you're doing a presentation on a screen, you get into Q&A after the exit strategy, and you talk about the conclusion. The conclusion slide is an opportunity to be a salesperson for the final slide. This is a chance for you to bring back all of the key reasons why this is an investable product. And you list them on the screen, you cover them at the end of your pitch, but then guess what? During the Q&A, which can go on for 12, 15 minutes, that slide stays up on the screen. I like that because I'm a sales guy and I don't want anybody to forget all the reasons why they can't go another minute without writing me a check. So what's wrong with having a reminder up there of why this is such an investable deal? And these are typically things you've already talked about during the presentation, but you're bringing them back one more time and leaving them up there because if somebody fell asleep for a few seconds and they didn't realize that your margins are greater than 80%, for example, that can be suddenly they wake up and realize, whoa, okay, I didn't catch that before. So I'm giving you some examples here of what makes something investable. Obviously, high margins are attractive. A critical component that makes it very attractive is an experienced management team. And you'll be able to demonstrate that from your team slide. Scalability is absolutely essential. If you have intellectual property, that's very helpful. A couple more suggestions would be if you're in revenue right now, that is a huge benefit because what that says is you got proof of concept, you got proof of customer. Okay, so and you're in revenue, so everything is in place there, and that's very encouraging. Every investor would love to invest in a company that's already got traction and they've already proven the concept that it works. So remember, okay, you're presenting to potential investors, not product consumers. This is a mistake I see many times that entrepreneurs make is they put together a presentation, but it's more of a product pitch, okay, not an investor pitch. What I just showed you is an investor pitch because you're going through all of the reasons why this is going to grow, how scalable it is. You've talked about what a fantastic management team you have. The profit margins are there. The sales channels are in place. We're ready to go. That's what's really important. So that is the end of my presentation, if I can get here. And I hope that I was able to share with you some very helpful hints today that I think properly put together can definitely help you get to that next level. I want to open it up for Q&A. If I can get some help here, I'm not sure why I'm not able to get these questions out.
No, I got you, Bill. I will ask the questions for you.
I was hoping you were there, Hannah. You always have my back. Thank you. Fire away, and I hope I can answer them.
Of course, we got quite a few questions. So the first one is, if I am flying solo but have contractors and a network of accomplished people I work with and advise, should I list them on the team page?
No. Yeah, the team page is only the team. It's your management team that are full-time or part-time, but they're a part of it. So in other words, that would be like the CEO, okay, the CTO, and the business development or the VP of sales or the operations person. What I'm looking for on the team is just the management team that is going to grow the business for me. Those are the jockeys. Okay.
Next question is, if I don't have an advisory board, are you pretty much out of the game?
Not at all. An advisory board is helpful, certainly not essential. It is only helpful if you have one. But if you only have one, it's kind of like putting one trophy on the wall. You might as well wait until you have 2 or 3 to put it up there. But you know, I'm offering the advisory board it's a very simple, informal agreement. We're not talking about board members here. I'm talking about just experienced people that have agreed to be called your advisor and somebody that wants to help you grow your business. Sometimes you can even compensate them. Everything is different. There's a deal for everything, but these are people that you know in the industry that are willing to be on your board. If you don't have any, that's okay. That's perfectly fine. I bring it up because if you can find them, it's always helpful.
Would you
Okay.
be able to share the template for the financial projection that you used to guide?
Sure, be happy to.
If you wanted to send that to me, I can include it with the recording.
Yeah, I have, what it is a snapshot, but it definitely will show you the format that is extremely effective. It gives the most of the information they want, and it's all you need during a 12-minute pitch. But yes, I'll send that to you, Hannah, to send out to them.
Okay, perfect.
Hmm.
How does a pre-revenue startup showcase financial projections? We have a revenue traction and loyal customers, but not a sufficient large scale to call it a revenue model.
So keep in mind that a 5-year projection, it's not fun to put it together. You have to remind yourself that it is what it's called. It's a projection, okay? And what you're doing is you're coming up with a formula through the thought process. You have a product, and your whole business model is based on, okay, I believe in the first year, based on my formulas, based on the research that I've done and all the customer discovery that I've done before I ever launched this, this is what I believe is going to happen in the first year. You could be way off or you could be under it, okay? But it's the best projection you have. What I'm looking for as an investor is how much thought did you put into this? Have you done your customer discovery? Customer discovery, by the way, is talking to the actual target customers to get an idea what they think of your product before you ever get out there. It's always critical to find out, okay, I think I got a great idea in a product, but I need to know what the customer thinks too. Hopefully that answered your question. If it didn't, please reach out to me later and I'll be happy to spend more time on that.
Funders always ask about IP patents. This is a continuing challenge for our startup where the patents filed by the inventor were not issued. However, our trade secrets are very, very strong. How do we deal with this prejudice towards patents?
If you, I'm not sure if I understood the question, so I'll try and answer it. And if I didn't, we can come back to it. Patents are great to have. However, when you file for a patent, a provisional patent, keep in mind, you're making the world aware already of what it is you're doing. So a lot of patent attorneys will tell you, don't file a provisional for maybe a year. Don't worry about it. Focus on sales, sales, and more sales. So I'm not sure, Hannah, you run that question by me one more time, because I'm not sure if I caught it correctly.
They were just basically asking how they deal with investors who want to see a patent versus not, I'm assuming.
Okay, and I would not get caught up on that. You can tell them, and what I typically do is tell them that we are in the process of filing a provisional patent. And we're talking to a patent attorney right now, if that's the case, and if it's not, you can be, but I would handle it that way. Very simple. Again, patent attorneys they'll tell you themselves that you don't have to jump right into that first thing out the gate. If an investor is hung up on just the patent, then you should be talking about other barriers to entry that you have in place that you feel will help you gain traction quickly. You know, the very fact that you're first to market with an idea is somewhat of a barrier to entry. Okay. Next question.
What are convertible and safe notes?
It's better to send you a document. I have a copy of both of them, and I can send both of those to you. A convertible note is both of them are promissory. Well, the convertible note is a promissory note. The safe note doesn't offer the investor any type of an interest that a convertible note does. So a convertible note typically has an interest that you're agreeing to because it's a promissory note. You're saying that, okay, we're gonna sign a note. It's basically debt, and what you're saying is you're going to pay 6, 7, or 8% interest over the course of time, and you're going to offer, when it does convert to stock, which typically they do, a 20% typical discount for the early adopters. So a convertible note is debt in reality. And the average interest rate, depending on how aggressive you want to be, is going to be between 7 to 8%. Some are at 6, but that's negotiable. So again, the safe note doesn't have any commitment for interest. It's one of these trust me type things. They work in some areas. I've had clients in Northern California that have done okay with safe notes. So you can try for it. I mean, they definitely protect the entrepreneur, but they don't give any good feelings for the investor, and that's why I discourage it. But you can always try it, and if it doesn't work, you can switch to a regular convertible note. Okay.
Should we put break even return metrics also in the financial section?
You can. Some people do. Yeah. It's not essential. But yes, you can go from red to black and show it that way if you want to. It's helpful. It helps share with people that you really thought this through, so you know where your break-even part is. Most of them will probably figure that out when they look at your 5-year. But yes, if you know that, put it in there. I'd have to see it just to double check it, but I think that's the answer to that would be sure.
Is the proof of concept slide similar to traction? If not, where do we put the traction slide?
Traction slide is, in my opinion, is subjective. It's good to have that. If you have some significant traction, I'd get it out at the very beginning because it's an eye opener. It's very different when you're doing a presentation and you're not just a very absolute out the gate with no customers yet. You actually have customers. That's an eye opener, and it changes the mindset right away. I mean, if you've got 100 customers and you're generating $10,000 a month in revenue, that's traction. That's impressive. And as a salesperson, I want to bring out everything I can right out the gate. That's important, just like the team is. So if you have traction, the earlier you show that, the better.
What are the strategies that founders should have so that they don't dilute their ownership down the road during other raise rounds?
It's very difficult to not dilute. In other words, it's a known fact. As an investor myself, if I invest in a company, there's a pretty good chance I'm going to be diluted. For example, let's say the first round is angel round for $1 million. 3 or 4 years later, when they're up to about $8 to $10 million in revenue, they go to a VC. A VC is going to come in, and it's called a cram down, and they're going to invest, and I'm going to be diluted, but I know that. But it's part of the risk that we take as investors. It's just a known fact. You're going to be diluted, but the bottom line is it's okay, because if the other investors come in, the company continues to scale now more rapidly, the end result is going to be a more positive liquidity event. And even though I was diluted, I'm fine with that because I'd rather get a $50 million, or let's say I'd rather get a 10x return than a 4x return. And if I got diluted, that's okay, because I made up for it in the more aggressive sales price.
Is it better to follow this exact pitch format, or does trying to be different hurt yourself in the end?
It's the format, the sequence is all subjective. You can talk to 20 different people and get 20 different ideas. It's purely what works. What I'm sharing with you here is not the end of everything. It's what I tried to do is I try to capture what I've seen. I probably have seen at least 1,000 presentations. So what I try to do on this this deck here today is share with you the type of content that I know investors are looking for. It answers a lot of the questions before you get them. And that's what you want to do. Plus, you want to tell a good story, an exciting story that gets my attention. So, the sequencing, I lay it out this way because I want to keep a hook out there. I want to lay out some information, but then I want to do another hook and grab their attention. I don't want anybody falling asleep on me. I want to keep them excited all the way through. So it's just a matter of your style, how you want to deliver it. The important parts, though, is you are telling a story. So you want to go from the beginning to the last chapter, but you want to lay it out there so everybody gets it all. So it's subjective. There's no perfect answer to that. The way I presented mine today is what I've seen many times and what appears to work the best.
Is it hard to value a pre-revenue company when issuing convertible notes? Should we specify a cap or not?
Yes, they're going to want a cap. In the past, that was not the case. In fact, many times people use convertible notes because they didn't have to show any kind of valuation. Today, they want to have a cap. The cap is basically the valuation of the company. I call it pre-money valuation. It's what is the company worth today. The other part of the cap is if they go out and they raise more money and it goes past that, then it starts converting it into stock. But typically, the cap is the valuation, and that's going to be a sensitive subject, whether you're doing a price round or you're doing a convertible note. The valuation is always going to be, a sore subject because it's going to be far more valuable to the entrepreneur than it typically is to an investor. But I have ways to help with that. And if somebody would like to go into that discussion, happy to share some ideas with that.
If revenue goals were not reached in first year, would you ever explain why projections were off and what can be done better with investment to be transparent, or do you not even bring it up? Is it too negative?
It's too negative. Again, the revenue projections are just that. Remember, they're projections. Nobody believes them. They just want to know that you're realistic. You're not, nobody's going to accuse you of, I'll use the bold term, smoking something before you did your pitch. They just want to see a realistic growth chart. And, again, there's no penalty if you go over it, but they just want it to be realistic. And they want to know that they're investing in a company that's got a good vision for some very strong, solid growth. Okay.
And then our last question is asking a possible investor to sign an NDA a no-no?
It's not so much a no-no, they just won't do it. So I can just spare you asking that question. They won't do it. We at TCA and other investment groups that I've been involved in, it's just their policy. They don't do it. The exception would be if you're into deep due diligence and it looks like it's going to go somewhere. At that point, you could ask for it because now you're really starting to share everything that's in your closet, and you can ask for it at that point, and it's not inappropriate. Some will sign it, some may not. But don't be afraid of that. Don't worry about it, because the standard is they don't sign NDAs, and I could go on for about 10 minutes to explain to you why. But bottom line is, you can assume that they're not going to. Okay.
Well, Bill, that was amazing. If this were a pitch, you would have gone into diligence. Everyone stayed till the end. You held their attention.
Well,
So just want to thank you so much for this great presentation and everyone who joined. Everyone will get the recording and slides and all of the extra handouts that Bill was mentioning tomorrow via email. If you're interested in one-on-one consulting, you'll be automatically routed to our sign-up link after this webinar, or you can call our hotline number there on that last slide on the left vertically, 800-616-7232. If you have any other questions, please email Hannah at hkhaled@fullerton.edu, and Bill's email is there on the slide as well. We're here to help you and your business start, grow, and succeed. Thank you so much for joining us today. Thanks again, Bill.
Thank you. Thank you, everyone, for listening. Appreciate it. Enjoyed the time. Best of luck.